let me be direct with you right now. And I want you to listen carefully, because I am not going to repeat myself, and I am certainly not going to sugarcoat a single word of what I'm about to tell you. You are running out of time. Not metaphorically, not as some motivational poster concept. You are literally, mathematically, statistically running out of the one resource that turns money into real wealth. And that resource is time in the market. Right now, as you are watching this video, Turkey just panics, sold 58 tons of gold in 2 weeks. Gulf sovereign wealth funds are quietly draining bullion out of London. Vaults at a rate not seen in nearly 70 years. Oil prices are spiking in a way that is going to restructure entire energy economies, whether politicians admit it or not. And sitting right in the middle of all of this chaos, two sectors that the financial media isn't talking about, sectors that your broker isn't calling you about, are absorbing institutional money at a pace that I find extraordinary. This is not noise. This is a signal. This is the last major wealth transfer event that many of you watching this video will have the opportunity to participate in before you retire. And I'm telling you right now that if you sit on your hands and watch it happen from the sidelines, that is entirely on you. Nobody is coming to save you. Not the government, not your pension, not Social Security, and certainly not the market, which does not care about your feelings or your timeline. What it does care about is capital, positioning, and timing. And that is exactly what we are going to talk about today. Before we go any further, I need you to do one thing. And this is the only thing I'm going to ask of you that costs you absolutely nothing. Hit the subscribe button right now. The framework I am about to walk you through is the same. Institutional thinking that money managers paid thousands of dollars a month to access, the same structural analysis that guides billion-dollar positioning decisions. You are getting it for free right here. Because I believe that if more regular investors understood how this game actually works, they would stop being the ones on the wrong side of every major trade. One button, do not overthink it, subscribe, and then pay attention, because what comes next matters. Now I want to talk to you about something that most financial commentators do not have the backbone to say directly to an audience, and that is this. The retirement crisis in America is not an accident. It is not bad luck. And it is not primarily the fault of the economy. It is in very large part the result of decades of financial passivity dressed up as prudence. Let me give you some numbers, because I deal in numbers, not in feelings. The median retirement savings for Americans between the ages of 55 and 64, the people who are closest to the finish line, is somewhere in the neighborhood of $185,000. Now, if you run that through, even a conservative withdrawal rate of 4% annually, which is the standard rule of thumb that financial planners have been citing for 30 years, you are looking at roughly $7,400 per year in retirement income from your savings. That is approximately $616 a month. Add the average Social Security benefit, which as of recent data sits at just over $1,900 a month, and you are looking at a combined monthly income of roughly $2,500. Now, I want you to think about what your actual monthly expenses look like. Your housing, your health care, your food, your transportation, your medications, and I want you to tell me honestly whether $2,500 a month covers that life. It does not. And what makes it worse is that inflation, which has been running hot and which is structurally going to remain elevated because of defense spending, supply chain fragmentation, and energy costs, is going to erode whatever purchasing power that $2,500 represents with every passing year. This is not a scare tactic. This is arithmetic. And the reason I am laying it out this bluntly is because the only way you change behavior is if you understand the actual stakes. The people who got wealthy in every major market dislocation, and I have seen more than a few of them in my career, were not the smartest people in the room. They were the people who understood where they stood financially, accepted the reality of it without flinching, and then moved decisively when the opportunity presented itself. That is what we're going to do right now. Because right now, there's a setup in the market that I believe is one of the clearest institutional entry opportunities I have seen in years. And it involves not one sector, not two, but three distinct layers of opportunity that are happening simultaneously. Understanding all three is what separates the people who build real wealth from the people who read about it afterward in a newspaper. The way institutions think about markets is fundamentally different from how retail investors think about markets. And that gap in thinking is the primary reason that wealth continues to concentrate upward. Retail investors chase, they see something going up and they want in. They see something going down and they panic out. They read headlines, they react to sentiment, and they get systematically separated from their capital by people who are operating with a completely different framework. The framework I want to walk you through is 3 distinct layers, and each layer represents a different type of opportunity that is available in the market right now. The first layer is what I would call forced selling, a temporary dislocation where large institutions, sovereign funds, or governments are compelled to liquidate assets, not because those assets have lost their fundamental value, but because they need emergency liquidity. This is a margin call on a geopolitical scale. The second layer is structural fundamentals. These are the deep, long cycle shifts in the global economy that create persistent demand for certain assets or sectors over a period of years or even decades. These are not trades, these are positions. The third layer is innovation, the emergence of new technology or new capability that disrupts an existing industry and attracts institutional capital well before the mainstream investor has any awareness of what is happening. Now, think about those 3 layers, like 3 different kinds of sales happening simultaneously in the same building. The first is a clearance sale, assets being dumped below their real value because the seller has no choice. The second is a grand reopening, a business or sector that was written off that is now structurally relevant again. The third is a brand new store opening, something that didn't exist before, or existed only in prototype form, and is now drawing a crowd of early institutional capital. Smart, long-term investors know how to recognize all 3, and they know how to size their positions appropriately for each type of opportunity. Most retail investors only ever see one kind of sale, usually the most obvious one, and usually only after the institutional money has already moved. What I'm going to do right now is walk you through each of these 3 layers as they exist in today's market, specifically, concretely, and without the hedging and equivocation that passes for financial commentary on most television networks. Let us start with layer 1. And this one is the most time sensitive because the window on forced selling events, by definition, does not stay open indefinitely. Turkey sold 58 tons of gold in just 2 weeks. Let that number sink in for a moment. 58 tons. That is the largest weekly decline in Turkish gold reserves in 7 years. And it happened for a very specific reason. They needed to defend the Turkish lira in the context of escalating regional conflict and the financial pressure that comes with it. At essentially the same time, Gulf sovereign wealth funds, ADIA, PIF, and others have been liquidating bullion positions out of London. Data from the London bullion vaults shows outflows of approximately 45 tons above the historical average during this period. Now, the critical analytical point here, the thing that separates institutional thinking from retail panic, is this. These countries did not sell gold because they stopped believing in gold. They sold gold because they needed cash right now to manage an acute crisis. There is a massive difference between a seller who has changed their thesis and a seller who is dealing with a short-term cash flow emergency. A distressed seller creates a discount. A discount on a fundamentally sound asset is an opportunity. The structural long-term case for gold has not changed by a single variable. Major banks have price targets on gold, ranging from $5,000 to $8,000. 95% of central banks, when surveyed, indicate that they expect to increase their gold holdings going forward. The US dollar is going to face continued structural pressure from deficit spending and the cost of financing defense and entitlement obligations and the ongoing accelerating trend of de-dollarization and trade settlements between non-Western economies. None of that changed when Turkey needed to make a margin call. What changed is the price, which dropped approximately 20% as a result of this forced selling. And that price drop, if you understand the framework, looks a lot less like a collapse and a lot more like a temporary discount on an asset whose long-term thesis is a fully intact. And silver compounds this opportunity because silver carries not only investment demand in the same way gold does, but also substantial industrial demand. Silver is used in solar panels, in electronics, in electric vehicle components, and in an expanding range of industrial applications. At the same time, no significant new silver mining capacity has come online because mine development is a decade-long process, and nobody was investing in it when the green energy narrative made precious metals politically awkward, So you have surging industrial demand, constrained supply, and now a forced selling discount on top of it. Whether you act on that or not is your decision. But I want you to understand exactly what you are looking at. Layer 2 is going to surprise some of you. And the reason it's going to surprise you is because the financial media and the ESG investment narrative have spent the better part of a decade convincing you that this particular sector was finished, was morally indefensible, and was economically obsolete. I am talking about coal. And before you close this video or roll your eyes, I want you to sit with me for 60 seconds and look at the math. Because the math does not care about your feelings about climate change. When oil trades above $90 to $100 per barrel, which Goldman Sachs is projecting for the foreseeable future, coal becomes the cheapest available alternative for power generation in virtually every major market. That is not an opinion, it is a cost curve. Europe is a perfect case study in what happens when ideology collides with energy economics. Germany shut down its nuclear power plants. European gas storage is critically low. And right now it is cheaper for European utilities to run coal-fired power plants than gas-fired plants. These are not fringe operators making marginal decisions. These are major national utilities rebuilding coal inventory because they have a winter to get through and their alternative energy sources cannot meet the load. The call for gas substitution in Europe is expected to persist through the end of the year if the current geopolitical environment continues, and there is very little evidence that it is going to resolve quickly. Meanwhile, India, the world's third largest oil importer, is using emergency government powers to maximize coal-fired power output to offset the supply risks created by Middle East instability. This is a country of 1.4 billion people, making a strategic decision in real time that coal is the bridge fuel they need right now. And then there is the steel angle, which most people completely miss when they think about coal, because they think of coal solely as a power generation fuel. You cannot make steel without metallurgical coal. There is no substitute for it at industrial scale. Every bridge, every military vessel, every railroad track, every skyscraper, the steel and all of it, requires coal in its production, and with defense spending rising dramatically across NATO member countries, with the United States committing to major infrastructure investment, and with reshoring of manufacturing, creating new domestic industrial demand, the steel sector is facing a significant demand cycle. That demand flows directly through to metallurgical coal. Now, here's the contrarian kicker that makes this genuinely interesting from a capital allocation standpoint, because the ESG narrative and the climate change investment agenda made coal essentially toxic for institutional portfolios over the last several years. Almost nobody has been investing in new coal mining capacity. Supply has been constrained by ideology at exactly the moment. That demand is being driven by economic and geopolitical reality. That is the setup. Constrained supply, surging demand, cheap valuations, because nobody wants to be seen owning it. The coal stocks are relatively inexpensive on a fundamental basis, and institutional money is beginning to flow back in. You can either be ahead of that flow or you can read about it after. Layer 3 is where I want to spend some time, because this one is not about a crisis or a dislocation. This is about a structural, multi-year wealth creation cycle that is already underway and that I believe is still in its early institutional phase. I am talking about biotech, and more specifically about the intersection of a $300 billion patent cliff, a desperate acquisition cycle by big pharma, and artificial intelligence, fundamentally restructuring the economics of drug discovery. Let me walk you through the mechanics of this, because once you understand the structure of it, the opportunity becomes quite clear. Between now and 2028, approximately $300 billion worth of pharmaceutical patents are going to expire. These are the patents protecting the most profitable drugs in the portfolios of companies like Pfizer, Merck, Bristol Myers, Squibb, and others. When a drug patent expires, generic manufacturers are legally permitted to produce equivalent medications at a fraction of the cost, and what typically happens is that the revenue on the branded drug drops by as much as 80%, almost overnight, once generic competition enters the market. For a company that's built its revenue model around those blockbuster drugs, that is not a minor headwind. That is an existential problem. And the pharmaceutical executives running these companies are not stupid. They know the cliff is coming. They know their internal pipelines are not large enough or productive enough to replace $300 billion in revenue through organic drug development alone. So they are doing what any rational, well-capitalized incumbent does when their core business faces structural disruption. They are buying the innovation from the outside. Big Pharma is on an acquisition spree, targeting small and mid-cap biotech companies that have promising drugs. In clinical development, pharma M&A deal value has jumped 31% in the last reported period. Venture capital funding into biotech went up 70% quarter over quarter. $3 billion flowed into the sector in a single quarter. And major pharmaceutical companies have committed over $480 billion toward U.S. manufacturing and R&D investment as part of a broader reshoring and reinvestment strategy. This creates a very specific and historically repeatable wealth transfer mechanism. When a large pharmaceutical company acquires a small biotech, they typically pay a significant acquisition premium, often 50%, 80%, sometimes 100% or more above the pre-announcement market price. If you are a shareholder in the right small biotech company before that acquisition announcement, you capture that premium in full. The challenge, of course, is identifying which biotech companies are most likely to be acquisition targets, and that is where the AI dimension becomes critical. Artificial intelligence is reducing drug discovery cost by approximately 40% and compressing timelines that used to take decades down to a fraction of that. Companies that previously required 1,000 researchers and 15 years to bring a drug from concept to clinical trial can now do it with a fraction of the staff and a fraction of the time. This makes small biotech companies dramatically more productive and therefore more attractive as acquisition targets, because Big Pharma is not just buying a drug. They are buying a platform and a capability. The innovation is real, the money flowing in is real, and the structural driver, the patent cliff, creates a ticking clock that makes the acquisition cycle not just probable, but mathematically necessary for the large players to survive. Now, I want to be clear with you about risk, because I am not in the business of misleading people. Biotech is a high-risk sector. The failure rate for drugs in clinical development is approximately 90%. A single FDA decision, a single clinical trial result, can move an individual biotech stock by 50% or more in either direction in a single day. This is not a sector where you put 30% of your retirement savings into one company and hope for the best. The appropriate framework for most investors is to get broad exposure through sector ETFs, vehicles like XBI or IBB, which give you exposure across hundreds of biotech companies and smooth out the binary risk of individual stock selection. If you want to take individual positions in specific companies, keep those positions small, no more than 1% to 3% of your total portfolio in any single name, and only in companies where you have done genuine due diligence on the pipeline, the balance sheet, and the management team. The structural drivers here are real and they are powerful, but they need to be accessed with appropriate risk management. Discipline, or you will find yourself on the wrong side of a binary event that wipes out a large portion of what you have built. Here's where I leave you, and I'm going to be as direct in this final moment as I was at the beginning, because that is the only way I know how to operate. You have just been given a complete institutional framework for three the most significant market opportunities available right now. You understand forced selling and why the gold and silver dislocation represents a temporary discount on assets with an intact long-term thesis. You understand structural demand shifts and why coal, regardless of how uncomfortable that makes you politically, is being pulled back into relevance by the cold mathematics of energy economics and industrial necessity. And you understand the biotech wealth transfer cycle, why $300 billion in expiring patents is going to force Big Pharma to write enormous checks to small biotech shareholders, and why AI is accelerating that entire dynamic. Now here's the binary question I'm asking you to answer for yourself. Right now, not tomorrow, not after you think about it, for a few more weeks while the institutional money continues to position. Are you going to act on this information, or are you going to watch it happen again from the sidelines the way you have watched every other major market move? Because I guarantee you that 3 years from now, people are going to be talking about this exact period, this confluence of forced selling in precious metals, the coal demand revival, and the biotech acquisition wave. The same way people talk about 2009 or 2020 At the moment, that was obvious in hindsight and invisible to most people. In real time, you are not most people. You watch this video. You have the framework. The only question left is whether you have the discipline and the conviction to use it. That is not something I can give you. That part is entirely yours.